This week on Moving Markets, the FBM KLCI has been weighed down by concerns that the government might introduce tighter controls on economic activity. Hartalega delivers yet another round of stellar earnings. The current wave of COVID-19 cases has caused retail REITs to struggle, but are they all created equally? And Wall Street digests tech earnings as well as a frenzy brought on by an army of day traders. Since the start of the week, markets have been spooked by speculation of stricter measures to curb the spread of COVID-19 by limiting more economic activity. With investors adopting a risk-off mode, the FBM KLCI has retraced by about 1% week to date. Malaysia is currently the worst performing major market in Asia, down about 3% year to date, while Singapore and Hong Kong are up about 3% and 5% respectively. Despite outperforming the region last year, the KLCI is now back to lagging behind its peers. This could be due to a rotation into laggard markets and political uncertainty, but will this remain the trend for the rest of the year? A year into the pandemic, and the divergence of the performance of companies has never been more apparent than in nitrile glove maker Hartalega's stellar earnings. The company announced core net profits were up by over 700% from a year ago, driven by an increase in average selling prices as demand continues to outstrip supply. Plus, while all the biggest glove makers reported cases of COVID-19 among their employees, Hartalega has managed the crisis relatively well, avoiding a major outbreak amongst its staff. The company's stock rose by 4% the morning after this news, though its share price has since corrected. It's currently up 0.5% year to date. Meanwhile, rival glove maker Supermax's results are due after markets close on Friday. Unlike gloves, retail REITs have not been a winner in this pandemic era, since footfall traffic has declined sharply even before the imposition of MCO 2.0. But not all REITs are created equal. IGB REIT, which operates Mid-Valley Megamall and Gardens, reported that its core net profit was down 4% from a year ago, but this was still above consensus estimates. This REIT is more resilient since its assets enjoy high occupancy rates with low reliance on tourist arrivals. Contrast that with other REITs like Pavilion, KLCC and CapitaLand Malaysia Mall Trust. Pavilion suffered a 33% decline in core net income, while CMMT saw a fall of over 40% year-on-year. KLCC Stapled Group, which includes KLCC REIT, posted its first ever quarterly net loss, with core earnings down nearly 20%. The fact is, CMMT, which owns the mines 3 Damansara and Sungai Wang Plaza, faces stiff competition around its properties, while Pavilion and KLCC have been hard hit by border closures and the absence of tourists. So, while retail properties will all benefit from the eventual loosening of movement restrictions, those with better asset quality and sticky tenants are better poised to weather the crisis than others. One unexpected consequence of the pandemic has been the rise of retail traders, and this week Wall Street was forced to contend with this new trend as day traders propelled shares of software retailer GameStop up over 900% year to date. Stock prices are usually self-limiting. They would only go so high before valuations become unattractive. But it would seem that retail traders pay less attention to these fundamentals in contrast to institutional investors. So much so that the skyrocketing of GameStop's share price has left some large hedge funds exposed to losses of between 30 and 100%. Meanwhile, also on Wall Street this week, some of the world's biggest companies reported earnings. Microsoft blew past expectations on Tuesday when it reported earnings of over $15 billion for the first time. The company saw growth across its segments, from its cloud computing software to its gaming and devices. Apple had its strongest quarter on record, with sales topping $100 billion, driven by strong iPhone sales, which have led some to believe we're currently seeing a supercycle where millions of existing users upgrade their devices. Still, the stock fell by over 3% in extended trading due to a lack of forward guidance, a sign we're not yet out of the woods and uncertainty is still here to stay. And that's what's been moving markets.